understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college. Videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their crafts when it comes to economics, personal finance, and more.
Okay, let's see what's gonna happen here with the FOMC. Meeting should be starting already. Wow, just at 2. First minute, we had a nice breakup off here. So now I definitely want to see some sort of support on gold. Sales would have been, if you had a sell stop, maybe down below here. It didn't run that much. Definitely with the spread, it could have been worse. I was thinking of having a sell stop below here, 1852, and a buy above 1861, which we didn't get. I'm actually looking for buys rather than sells. We still got another 30 minutes for more news to come out, like the rates, and actually trying to stream here what Biden's got to say before Powell. Let's see. I got that spike down on gold. Let's see if it continues down here.
Trade from right.
Okay, definitely getting copyrighted for that. I think of federalreserve.gov for the live stream. Friday, Wednesday. Anyone got the link or no? It's at 2:30 though, so let's see.
And financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
Geez, I wasn't expecting that quick dump like that. Definitely sales would have been right at this break here at 1854. Buys now, depending on how this is setting up. see price breaking this, continuing down. That was a nasty drop. Yeah, I wasn't expecting that right off the bat at 2 p.m. It's at 1840 right now. The conference is at 2:30. I'll be right back. Give me 1 second. Yeah, well, GBP pairs, you usually move somehow. Don't just whip around. Yeah, it took a couple of minutes off for couple minutes off.
Yo, what's up, Matt?
What's up, Trey?
You looking to trade?
No, man, I'm not really looking into trades. I just want to see how gold reacts when Powell's got something to say.
Gotcha.
Yeah, this 2 p.m. drop, probably because of the rates. Let me see. I think they stayed the same. But they're gonna talk about long-term rates for 2022 and 2023. Also tapering on the monthly budget. And what else? Oh, and inflation. So should be a good meeting. Quarter.
You aren't usually the biggest fan of the buy stops and sell stops, huh?
No, not really. I mean, they work, but the thing is the spread, right? If you would have had a sell stop down here, probably call it a decent sized trade. Um, it did move in 15 minutes, but between the spread, commission, and whatnot, maybe this drop wouldn't had. Imagine if it would have been that deep, it would have been up to here only. You could have got caught at least 40 pips. Of course, closing with your normal size spread. But now I do want to see gold respecting that zone. This zone we tapped into, 1833. This is coming from here, right? Previous support. That held. Then we have also 1837 up here. So that range. Above that range we have this range, and so on. This is of course keeping the sell bias, but you never know, man. These things are priced in, and whenever they say something is good for the economy, you can expect gold to not move or even go up sometimes. Good for the economy, gold's supposed to go down. Bad for the economy, gold is supposed to go up, acting as a safe haven. But yeah, a lot of these meetings are already priced in. I wasn't expecting this nasty drop at 2.
I was expecting to buy for sure.
Now, still got 3 more minutes for the meeting to start. It's not gonna be right away. Lex, stop, man. But I do wanna see at least what Powell's gotta say. Captions on. And this guy cat's hungry. did I even draw this? Oh, it's working. Huh. Oh, there it is.
And real GDP this year appears to be on track to post its fastest rate of increase in decades.
I don't know if I can restream this.
Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Household spending is rising at a rapid pace, boosted by the ongoing reopening of the economy, fiscal support, and accommodative financial conditions. The housing sector is strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. Forecasts from FOMC participants for economic growth this year have been revised up since our March summary of economic projections. Even so, the recovery is incomplete, and risks to the economic outlook remain. As with overall economic activity, conditions in the labor market have continued to improve, although the pace of improvement has been uneven. Employment rose 419,000 per month on average in April and May, with the leisure and hospitality sector continuing to post notable gains. Employment in this sector and the economy as a whole remains well below pre-pandemic levels. The unemployment rate remained elevated in May at 5.8%. And this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months against a backdrop of rising vaccinations, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.5% at the end of this year and declining to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower-wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably in recent months. The 12-month change in PCE prices was 3.6% in April and will likely remain elevated in coming months before moderating. Part of the increase reflects the very low readings from early in the pandemic falling out of the calculation, as well as the pass-through of past increases in oil prices to consumer energy prices. Beyond these effects, we are also seeing upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly as supply bottlenecks have limited how quickly production in some sectors can respond in the near term. These bottleneck effects have been larger than anticipated, and FOMC participants have revised up their projections for inflation, notably for this year. As these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal, and the median inflation projection falls from 3.4% this year to 2.1% next year and 2.2% in 2023. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of monetary policy. The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of COVID-19 and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed, and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now. More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative. Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month, and of agency mortgage-backed securities by at least $40 billion per month, until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals. As we have said, we will provide advance notice before announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
All right,
Mr. Chair. First, we'll go to Rachel Siegel, The Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our
Adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country.
walk us through expectations you have specifically when it comes to the labor market going into 2023. And I'm curious about people who may have left the labor market, who have yet to come back, or who may face issues with childcare, perhaps they've retired early. Any barriers that you see keeping people from the labor market as you consider full employment going into 2023? Thank you.
Thank you. So I would say if you look at the labor market and you look at the demand for workers and the level of job creation and think ahead, I think it's clear, and I am confident that we are on a path to a very strong labor market, a labor market that shows low unemployment, high participation, rising wages for people across the spectrum. I mean, I think that's shown in our projections. It's shown in outside projections. And if you look through the current time frame and think 1 and 2 years out, we're going to be looking at a very, very strong labor market. In terms of exactly what that means, we'll have to see how things evolve. I think we learned during the course of the last very long expansion, the longest in our history, that labor supply during a long expansion can exceed expectations, can move above its estimated trend. And I have no reason to think that that won't happen again. At the same time, we have seen, in terms of participation, we've seen a significant number of people retire. And so we don't actually know exactly what labor force participation will be as we go forward, but I would tend to look at it and think that it can return to high levels, although it may take some time to do that. But overall, this is going to be a very strong labor market. In terms of the near term, you ask as well. So we see a couple of things, a few things that seem likely to be holding back labor supply. There are very large amounts of job openings, and there are a very large number of people who are unemployed, and the pace of filling those jobs somehow feels slower than it might be. So I'd point to a number of things. The first of which is just that most of the act of sort of going back to one's old job, that's kind of already happened. So this is a question of people finding a new job. And that's just a process that takes longer. There may be something of a speed limit on it. You've got to find a job where your skills match what the employer wants. It's got to be in the right area. There's just a lot that goes into the function of finding a job. So that's sort of a natural thing. In addition, I would say that we look at, for example, a significant number of people still say that they're concerned about going back to work in jobs where there's a lot of public facing because of COVID. So that's clearly holding back some people, and that should diminish as vaccinations move ahead. There's also the question of childcare. Many are engaged in caretaking, and as schools reopen and childcare daycare centers open in the fall, in the fall, then we should see that supporting labor force participation by caretakers. Finally, unemployment insurance for something like 15 million people will either end or be diminished as we move through the summer and into the fall by the end of September. And I'd like some that may also encourage some to go back in and take jobs. So you would think that would add to an increase in job creation as well. So you put all those together, I would expect that we would see strong job creation building up over the summer and going into the fall. I will also say, though, the last thing I'll say is this is an extraordinarily unusual time, and we really don't have a template or any experience of a situation like this. And so I think we have to be humble about our ability to understand the data. It's not a time to try to reach hard conclusions about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient. And I do think, though, that we'll be seeing some things coming up in coming months that will inform our thinking.
Thank you. Paul Kiernan.
Hi, Chairman Powell. Thanks for the question. The committee's medium forecast on inflation seems to assume a pretty tame outlook for the rest of the year. As you know, the 3-month annualized rate for the past 3 months was, I think, 8.4% in the CPI. And I'm just wondering sort of how much longer we can sustain those kinds of rates before you get nervous. Thanks.
So inflation has come in above expectations over the last few months. But if you look behind the headline numbers, you'll see that the incoming data are consistent with the view that the prices that are driving that higher inflation are from categories that are being directly affected by the recovery from the pandemic and the reopening of the economy. So for example, the experience with lumber prices is illustrative of this. The thought is that prices like that have moved up really quickly because of the shortages and bottlenecks and the like, they should stop going up, and at some point they in some cases should actually go down. And we did see that in the case of lumber. Another example where we haven't seen that yet is prices for used cars, which accounted for more than a third of the total increase in core inflation.
Yeah, basically he's saying that the economy is en route to get better. Basically, damages from the pandemic are being fixed. Also, when it comes to the tapering down, they're not going to taper down the monthly expenses from 120 billion, so that's still good for the economy. That's why we had a slight this little dump on gold. Inflation talk is still there, but they're trying to reduce it as much as possible. What else? For 2022, 2022 and 2023, they don't expect any rate cuts. Rates stayed the same as of right now, 0.25%. So yeah, good for the economy. Gold is having a nice dump right now. We might change the structure from that bullish momentum we were having to something bearish as we're breaking below the 1840s again. I'm probably gonna have a correction. Usually when there is a news involved movement as big as the FOMC or CPI or NFP, there's usually a technical retracement to correct some of that move. So that's good. I mean, for anyone that was thinking of gold long-term buys, clearly that's not the bias right now. We're looking for sales rather to fit the bias. For tomorrow, probably we're gonna have that retracement up and fix some of this dump we had, right, from 2 p.m. Down to 2:30. It did move, let me see, from down here, 1852, that was the ideal sell, to current price at 1830, 1831, 220 pips, a $23 move. So yeah, we still have a lot of room for gold to get a good trade in. Definitely I want to see support for buys for tomorrow to correct some of that move. If not, then long-term sales as we're retesting that previous support that broke at 1853 down to 1817, 1800s even. So yeah, we're on a bearish trend right now. The economy is not the best, but based on whatever the changes are made, we can expect some boost on the dollar. So let's check the DXY for 1 second. Yeah, bullish. Remember, money prints like paper, so the more prints, the boost the economy will have. So yeah, recovering. So yeah, guys, that's it. Expect to get some buys for maybe tomorrow to have some correction for this move. But yeah, overall, rest of the month probably looking for sales. That was it. Didn't set up any sell stops or buy stops. I wasn't gonna risk it anything because things might have been priced in. I had an alert right above 1860, which we didn't break, and right below this 1853, another alert which got activated, but I didn't get into any sells or buys. UJ seems to have broken out of this range, which is good. Price can continue up to 111. UCAD it did break above that previous resistance we had here from I think it was CPI. and broke above 1.225, another major quarter point. Next resistance on UCAD, which will be here at 1.28, and right above here also 1.23. Yeah, 1.22, 1.23. As of UJ, next resistance can be here. And current support is down here. Alright, so that's it for today. I'm gonna go ahead and close this. Thank you everyone for showing up. Hopefully you learned something for gold. Yeah, price on US 30 shouldn't be going down, but we've seen this happen so many times. You know, good for the economy, stocks, things like that, indices should be going up. But yeah, sometimes things are priced in. US 30 Dow Jones didn't move as much. They spiked down. And yeah, for gold, gonna be looking for sales now. So thank you everyone for showing up. I'll see you guys tomorrow. Be safe and have a great day. Bye bye.